Warren Buffett is recognized as one of the greatest investors in the world. His company, Berkshire Hathaway, has beaten the S&P 500 by an aggregate of nearly 2.8 million%. How did he do this? Well, one of Warren Buffett's secrets is picking dividend stocks that have a sustainable competitive advantage and that pays an increasing dividend over the years. In this video, we'll be looking at three of Warren Buffett's longest held stocks that give dividends of 20 to 51% per year based on his initial cost basis. Welcome to the Dealmaker channel. If it's your first time here, I'm Ronald and I talk about investing in multiple asset classes such as global stocks and real estate. If you like this video, please leave a like and consider subscribing to get more content like this. Let's dive in. First on the list is financial services company American Express. Warren Buffett bought Amex in 1993 at $8.49. The annual dividend that Amex issues now in 2021 is $1.72. This has already increased from the time that Warren Buffett bought it in 1993. So his yield now is at 20.3%. Berkshire owns more than 151 million shares of Amex, and that gives them a yearly dividend income of $260 million per year. So this is passive income that Berkshire receives, and this is income that they can use to buy more shares. That's why Berkshire is sitting on billions and billions, more than 100 billion in cash. Second company on this list is credit ratings agency Moody's. Berkshire bought this in the year 2000 at an average cost basis of $10.05. The annual dividend in 2021 is at $2.48, and that translates to a yield of 24.7% based on his initial cost basis. Berkshire owns more than 24 million shares of Moody's, and that gives Berkshire passive income of $61 million per year. Before we go to the number one for Warren Buffett's top yielding dividend stock, let's look at how do you get 20 to 50% dividend yield. How does Warren Buffett get 20 to 50% dividend yield? Well, first, you need to buy a solid company that pays out dividends. Obviously, you can't get dividend yield if the company does not pay out dividends. So at this point in time, this rules out companies like Amazon or Facebook or many of the tech companies that don't pay out dividends. Next, you need to be patient and hold for a long time. Now, Warren Buffett has owned these companies for a long time. He has held American Express since 1993 and Moody's since the year 2000. So you need to be patient and hold for a long time because initially, these dividend stocks have low yields. They would probably yield anywhere between 1 to 4%. Now, 5-6% is already high in the US stock market. But if you're patient and hold for a long time, as these companies raise their dividends, ideally they raise it every year, your dividend yield will increase based on your initial cost basis. Now, we don't have the billions that Warren Buffett has, so whenever we buy companies like this, you need to continue buying and reinvest the dividends to let it compound. So notice how many millions of shares that Warren Buffett owns. We don't need millions of shares, but should you want to retire on dividends, you do need to own a lot of shares of these dividend-paying companies. So that's how Warren Buffett gets high dividend yields of 20 to 50%, right? He buys a solid company, holds it for a long time, and lets the company raise dividends every year. So he doesn't sell, he doesn't buy and sell. He actually owns companies for the long term, and he buys more of the company if it's still at a good price, or he buys other dividend paying companies as well. It's a very simple strategy that anyone can execute. And if you like that, please make sure to hit the like button for the YouTube algorithm. That helps the channel grow and it helps YouTube share this video to more people. And feel free to share to your friends who are thinking of investing in the global stock markets. Moving on, the number one company that gives the highest yield based on Warren Buffett's initial cost basis is beverage drink maker Coca-Cola. So we all know Coke. Warren Buffett bought this in 1988. He bought it for $3.25. Right now, Coke gives an annual dividend of $1.68. So that gives him a yield of 51.7%. And Berkshire owns 400 million shares of Coca-Cola, and that gives them an annual income of $672 million. That's a lot of money. That's a lot of passive income. That's why Warren Buffett is recognized as one of the greatest investors of our time, and it would be cool to be able to buy a company like this. So remember, buy solid dividend growth companies and hold for a long time. You don't need to get in and out of these companies. You just keep buying them, use the dividends to buy more companies, and you can do that because in the US market, you can buy with fractional shares, so you can just keep on compounding these dividends, let your portfolio grow, and let your passive income grow. Again, if you like more content like this, please consider subscribing to the Dealmaker channel to get more content about investing in multiple asset classes such as global stocks and real estate. If you're new to the market, check out our Stocks for Beginners playlist, and you may also want to check out my latest stock analysis video. Always remember, it's a great day to make deals, and may all of your deals push through. See you on the next video.